Good morning, everybody, and welcome to the very first Portfolio Insights webinar. This is the very first session. We are live. It's a very rainy, miserable day in Hong Kong, but hopefully we can bring to you some, brighten up your day and bring to you some of the real insights into some of the strategies that we want to talk about over the next few days. My name is Paul Calagiru. I'm the Client Portfolio Manager for our Multi-Asset Solutions business here in Hong Kong. And we're very happy to have with us today Mr. John Adio. John is the Global Chief Investment Officer of our Global Fixed Income Platform. And also John is the Primary and Lead Portfolio Manager of the Multi-Asset Solution that we're going to be talking about today. Just to kick off the discussion, John, maybe we can start with maybe an introduction into the Global Multi-Asset Diversified Income strategy. Maybe give an idea of the key attributes, what it aims to achieve, the key objectives of the strategy. Just to sort of kick off that discussion, and then we can get through some of the questions as we go through the 30 minutes.
Very good. Well, first of all, Paul, thank you. And it's a pleasure to spend a little bit of time with you today. Good morning, everyone. As Paul referenced, our global multi-asset diversified income strategies utilize essentially all of the resources of the organization, fixed income, equities, an option overlay strategy, and as importantly, the intellectual capital of our asset allocation team. So bottom up, focus on the company fundamentals, the management team, cash flow, income generation, the balance sheet. But in this case, we also bring to bear a really powerful resource that we have organizationally, and that's that asset allocation team, which operates globally and utilizes a combination of tools to find solutions for their clients. And as a team, then, it's that combination of the fundamental approach we take for security selection, married with that asset allocation view, which is going to have an outlook to different segments of the market to generate income.
So what is your thoughts on what we've had over the last week or so post the FOMC, your thoughts on rate hikes, your thoughts on yields?
Great. Well, I think it's important to look back historically at the trends that have been in place for virtually a generation. I was lucky enough to start my career in investing in the mid-1980s. And in fairness, it's safe to say we've seen a secular decline in interest rates since then. And today, with interest rates where they are and concern about two really important things, the first being inflationary pressures, and whether those pressures are going to be transitory and relatively short-lived, or if they're going to be sustained, in which case we're entering a new era of inflationary pressures, which will force interest rates higher. Really a situation that most investors are not truly accustomed to. Now, we did see that manifest itself to a degree in the first half of this year, primarily the first quarter, where we had over an 80 basis point backup in the US 10-year, for example, as investors and economies started to turn and recognize the idea that the growth rate in the global economy would be significantly stronger in a post-COVID environment. If we think about that risk, and then the other risk that you referenced, I think, which is the likelihood that global central banks, the FOMC, in particular, as you point out, but global central banks in general are going to have to reposition for that recovering economy. And so the extraordinary measures taken to ensure that we didn't see global economic collapse are going to be backed off. And so certainly, if we look back to 2013, for example, and the taper tantrum, it's a very fine line that we have to negotiate to ensure that there's not a disruption to the underlying economy by central banks moving too quickly to reduce the liquidity that's been in place. I would say the joke that most people are really throwing around these days is just the idea that the Fed in the US is talking about tapering. And so in another 2 to 3 months, they'll be talking about tapering. And then perhaps 3 months thereafter, we'll start to see action. Now, that unwind is going to be very thoughtful. I think the Fed and all central banks have really found value in transparency. And so we'll see an approach that's really designed not to spook the markets. But in fairness, that's not to say it won't happen, because it's a heavy lift that has to take place.
So just on that vein then, in respects to the Fed and sort of removing or tapering liquidity, shall we say? I mean, how do you see that affecting the sort of the income distribution or capital appreciation?
In the case of high yield or less than investment grade bonds, we find them to be compelling because of the general economic improvement that's underway. So the fundamental conditions, health, if you will, of these companies is improving as the economy improves. And the way that manifests itself is in the default rate. And so the number of companies filing for bankruptcy or restructuring is going to go down. And some strategists and our portfolio managers are of the belief that that default rate could be close to zero in 2021. And that's really important because the compensation that we're getting above and beyond that which a treasury bond pays is compensation for that fundamental risk that we're taking and the chance that one does not get paid back fully upon the maturity of their bond because that company is in distress or has financial difficulty. So we think the wind's at your back for credit, and therefore we're very selective, but we're willing to take credit risk given where we are in the economic cycle and the improvement that we're seeing in the global economy.
So maybe you can sort of touch upon sort of our thoughts around emerging market credit and sort of developed market high yield credit. And obviously there's within emerging markets and there's subsectors within there, there's high quality duration bonds, there's sovereign emerging markets, there's credit, there's local currency, EM debt. So depends which part of high yield, US high yield you want to compare against, but maybe you can just give us a flavor of your thoughts around preferences, income opportunities between emerging markets and developed markets.
I think the most important consideration is the backdrop that we face in the global economy, and it's really driven by the pace at which vaccines are being rolled out into different economies. And so it is a pretty dramatic compare and contrast country to country around the globe. We really think about three primary levers when we evaluate opportunities in fixed income. And so it would be geography, as you said. We can look at developed markets and we can look at emerging markets. It will be quality, and we talked about our attraction to less than investment grade credit in this market environment. And then the other piece is within a capital structure, the flexibility that we have. So we can own senior secured bonds, we can own unsecured bonds. We can also move down into a lower part of the capital structure, a hybrid part of the capital structure that's more equity-like in terms of its volatility profile. And there what we find is higher rated companies with a junior exposure in their capital structure that pays us a very compelling yield. As you would expect in a market environment where income is really hard to find because rates broadly are very low, when you have an expertise in an area like preferreds and we have a fundamental approach, we can actually find really compelling investment opportunities down in the capital structure that offer us a better return profile. So we focus on risk-adjusted returns, and if we can find something that's less sensitive to interest rates, because we are concerned that interest rates are going to rise, and more exposed to the company's improving fundamentals, that's a win for us. And that's what we can find in both high-yield bonds, but certainly in preferred securities as well.
Thanks, John. So if we sort of move to another component of a GMADI, which another interesting component, which is the options component, the options writing component. Maybe we can sort of start to talk around that and how that sort of is used to sort of generate income and enhance yield.
So within the option strategy, we really have two distinct elements that we utilize. So we're going to write both puts and calls. And the goal really is quite simple. It evolved a little bit over time, but initially the goal was really to derive income from the premiums that we receive for writing those options. And in a very simple way, The goal was to effectively take an equity exposure, and by overlaying an option on that exposure, say in the case of calls, we could create a more bond-like stream of income.
So just following on the options questions, there's a question here from our audience. The question says, why are active managers, how can they better manage options versus individual investors? So why can active management manage option strategies better than individual investors?
Well, there's a really important consideration there, and I think it's as simple as liquidity. And so when we write our options, we use broad indices to do that. And many investors will write options on single names. It's fascinating that those markets, despite their increased use, aren't really as liquid as we would like them to be as an institutional investor. And so we find a lot of value in the broad indices. And I think ultimately investors can write options. I think if they want to do that, they have to be disciplined in their approach. And I think the idea with options for us is it's a source of income. It's also a risk management tool. It's not a tool that we would look to generate outsized gains. And in fairness, when we have a really strong fundamental view on a company that we own, we're less inclined to write options on that single name, right? And that's why we effectively don't use single name options in this strategy.
Yeah. So just moving on to maybe another component of GMAT. We talked about the fixed income portion. We talked about the options portion. Moving on to equities. Could you maybe sort of detail how the equity bucket is positioned, and also maybe touch upon that debate around growth, non-growth, which is clearly being had by markets, and it's this constant sort of struggle between sort of what are the beneficiaries in this environment. Maybe you can walk us through the sort of the reasoning behind where we're overweight, underweight, and your thoughts around that going forward.
Coming out of COVID, there was a view that there would be certain parts of the market that would respond better to an improving fundamental economic backdrop. One of the things that you notice here is the overweights are fairly cyclical, in some cases defensive. The underweights, perhaps surprising, perhaps not. Tech certainly has had a very significant run coming out of COVID, or even through COVID for that matter. And certainly from a valuation standpoint, there would be a concern that it was a little overdone. And it's a combination really of a global equity orientation and a US-centric large cap core orientation. So it's not really a growth versus value play. It's really fundamental opportunities. It's something of an eclectic mix because it really is a fundamental approach to driving that exposure. So again, I think the real emphasis of this capability is to be truly dynamic in the approach we take to finding opportunities in all of the asset classes, equity, fixed, and within the option sleeve.
And maybe just to sort of go into that detail around the team, maybe you can just highlight the level of resources and the collaboration that's involved. I mean, this is a multi-asset strategy. It's across geographies. It's across asset classes. Maybe you can just highlight, how that team is brought together.
So as you noted, I'm CIO of our global fixed income business. Steve Medina, who's CIO of our global equity business, and Nate Tuft, who's co-head of our asset allocation team. And so the three of us are the most senior investors within our organization. And we utilize within those capabilities, senior perspective from the equity team, senior perspective from the fixed income credit team.
Thank you. Thank you, John.